Okay. So we are all welcome once again to the 8 weeks Forex basis by Kelfa. So I'm Kelvin. Um, I believe up to now, some of us are learning new things, or some of us are learning things that is are becoming helpful to the foundation or our basis for trading. Um, I understand that not all of us here are new or are beginners to Forex. Some of us have been trading already, and we still want to all put our heads together and then learn. Today, we are going to look at liquidity. So, what is liquidity and how can we identify liquidity? And probably you might have been hearing the word liquidity, liquidity. Like we always say, yeah, market use me as liquidity, liquidity sweep, all those things that we always hear ourselves talk about. But what is liquidity actually? So Ben, Uchena, Precious, Esther, Mary, today we're going to look at liquidity. Um, there is one experienced trader that I've been watching on YouTube. He called himself Mr. Liquidity. It's fun, but it's very important. Liquidity. Great. So, liquidity is where people's money in the form of stop losses, buy stops, sell stops, and so many others, where those people's, money actually resides or rests. Okay. So liquidity is where money is. Like if we want to use a short form of mathematics, then we can say liquidity is equal to money. Okay. So when you hear liquidity, liquidity, liquidity is money. Okay. Um, so liquidity is the availability of others in the market that allows you to buy or sell without big price changes. In Forex, it is the fuel that moves the market. Without liquidity, price can't move smoothly. In other words, it is where liquidity is residing or resting that the market gravitates towards. Market draws to liquidity. The market draws to money. So if you are trading a particular pair and you find that the pair has been moving one direction, let's say it's been moving to the downside for a long time, okay? The reason might be it is moving towards money, towards liquidity. Okay, that's the only reason it's moving towards money. Okay, and if you look at the first statement here, that money is people's money. It's your money and it's my money and other people's money. And it is in a form of stop losses or buy stops or sell stops and many more. So now let's get a deeper understanding of liquidity in trading. So so like I said already, all the cluster of pending orders where people places their take profits, stop losses, like I said already, everything put together where it's resting or where it resides in the market is what we call liquidity. So your job should be or will be to, when you go on any chart, start to find out or ask yourself, where will people's stop losses be? Where will people's buy stops or sell stops or whatever be? So once you start asking yourself that question in a particular chart, then you'll be getting yourself closer to finding out where liquidity is resting or money is resting. We also have institutional orders, and that is banks and hedge funds. So those big people or smart people, they come to the market, or they move the market, they make the market, and they have large volumes of money, and they need this liquidity, or they need liquidity to fill their large orders without causing wild price swings. So they need the retailers, they need we, the smaller people, they need our stop losses. Okay. They need our TPs. They need us to, I mean, they need to take us out so that they can run and drive the market to the direction that they want. So when we say there is liquidity run, or liquidity is taken out, or market is moving towards liquidity, there is liquidity resting somewhere, you should know that the smart traders who want to move price to capture that zone or that area before price will go to the intended direction. So price itself is attracted to these areas because the big players know their orders to match theirs. So price is attracted there. That's why I said market or price gravitates towards where there is money or liquidity. So it's important for us to understand that in particular chart, and we will go to the real chart to really map out examples of this. There is external and internal range liquidity. Okay, so there is external liquidity and there is internal liquidity. So to be able to, so first let's start with external liquidity. To be able to identify external liquidity, you first have to define an active swing structure, or what is also called dealing range according to ICT. Dealing range or swing structure. Okay. And two, the high or lows of these ranges has external liquidity or money or stops or pending orders resting. Okay, the highs or lows of this external high range or structure has this external liquidity. And within the swing structure or range, or within the dealing range, we can also find or map out internal liquidity. That is, internally, the highs and the lows of those ranges, internal ranges, we can also find liquidity there. And we have to understand that anytime price takes out an internal liquidity, it might want to reach out to the opposing external liquidity. Or anytime price takes out an external liquidity, it might want to reach out to the opposing internal liquidity, or the vice versa. Also, anytime price takes out an external liquidity, let's say external high, it might want to reach out to the opposing external low. Okay, so that is the way that the market will move, because you move towards money, you take all the money out, then you have to move towards the opposite side to also take out money. So let's go real quick to the chart and try to practice or find out how to map up our external and internal range liquidity real quickly. So here I have my trading view here opened, and I have gold on the 4 hour. Can you all see my chart?
Yes, I can see your shots.
Yes,
Okay.
I can see the picture.
Thank you. So this is the 4 hour on gold for me. Okay. So I said that first we have to define an active swing structure. So from our previous classes, we have seen that an active swing structure is any movement from one point to the other point that breaks structure. Okay, so let's say if price moves from this point low here to the upside like this and drops like this, and then price moves again and then takes out this previous high. And we've already learned about different market conditions or different price structures, the bullish trend, bearish trend, and the consolidation or ranging. We've learned that. So if we see something like this, then what did we say? We said that from the point, this low point to that high point that broke structure within here will become our swing structure. Okay, and that is also called our dealing range. So this high here and this low are going to be our swing range within here. Why? Because this move to the upside broke this high, took this high out. It broke structure. And I had said that with this dealing range, what we have to do is the first thing to do is to use our Fibonacci to measure from this low to the high. And within that, uh, we have to identify our premium and discount zone and the equilibrium. So the premium zone is above 50%, and that's where we look for sales. And below the 50% is the discount zone. That's where we will look for buys if we want to go up and expect another break of structure or break of this high. Okay. And the 50% is the equilibrium. 50% is the equilibrium. Good. So now we have premium zone up here and we have discount zone up here. I hope all of you understand this already. One, we need to see a break of structure, a clear break of structure. And then once we see that, we can use our fib to measure from the low to the high. This is a bullish example. And we will map up our swing structure or dealing range. So once we have this range like this, okay, what did our so the highs or lows of these ranges has external liquidity. So it means that below here is liquidity. This below this here is liquidity. And above this high is liquidity. And what did we say liquidity is? We said um, liquidity is
Money.
where stop losses, pending orders, take profits are resting. Okay. So it means that up here, those who might be, if we see a reaction or price dropping down like this and fails to go up again, if we see a reaction like this, if we see a reaction like this, those who took this sell, their stop losses will be above this high here or around this area. And that is what we call liquidity. That's the area we call liquidity zone. Okay, so this is external liquidity. What is happening inside these substructures that is coming down? It's not external liquidity. Okay, this is not external liquidity. So let's say, for instance, price keeps moving down, and then takes out. This is not a very nice price action, so forgive me. And price takes out this low. What do you think? Those who bought, okay, so let's say price even did not move straight up. It moved by, okay, let's say it moved up straight. Those who bought from this area, from this area, all their stop losses will be below here. And some people too will be putting sell stops below here that in case price tests this area as support because there is price stopping here and moving up and it breaks, it should take their orders and push it to the downside. So sell stops will be here. And those who put the sell stops here, their stop losses will be just a little above the support area here. Okay. So one, we have people putting sell stops here. Those who bought to their um, stop losses are here, the same place. Okay. Now, those who also sold, their stop losses are above here. So the moment price moves and defiles this discount zone, we don't get the confirmation and it defiles this area and sweeps this area. It takes out those who were buying. They thought price will reverse at 50% or discount and go up. That's what they thought, but it never happened. So now market drops down and then takes them out. So once it takes them out, those who also put sell stops here, it fills their orders and then start going down and they are in profit. And their stop losses is also above here. So first it takes the buyers out. Then you will see that impulsively price will move up to this area. Those who were selling would think that okay, price just broke, so it's coming back to retest. So it will fake that it wants to go down again. Oh yeah, it will go down, it will go down. And then this time, boom, okay, boom to the upside. Now, once it's going to the upside, where do you guys think it's targeting? It has already taken external liquidities or liquidity low here. So definitely is going to target taking another external, the opposing external liquidity, which is those who sold their sell stops. So that's the way that the market could be moving. Okay. Now, as it took this external liquidity down here, let's see all the in substructures here, the internal highs that price will be taking, they become internal liquidity. All the break of structures that will be happening internally, they become internal liquidity until price finally takes out the external liquidity. Once price finish taking out the external liquidity, that's what I said here. Once price takes out internal liquidity, it reaches out to external liquidity. Or once price takes out an external liquidity, it will reach out to external liquidity. It's just like that. Okay. So now that price has taken out an external liquidity upside, is very, very, very likely that it will drop down. It will drop down. Okay. So as price was going up, those who were uh, those who were joining the buy. So let's say price even did not move straight up. It moved up small, then it dropped down. Then it moved up again, break structure, then it dropped down. Then finally, it pushed up. So once this external high or liquidity is taken out, price will drop down, take out internal liquidity, which is those who join the buy here, their stop losses will be below this previous low here. Those who even join the buy, their stop their some stop losses could also be here. So price will drop to take out as far as it can stop losses and then continue to go up or go up again. And then if price really wants to sell, then this time, boom, a big move will happen. So this is not the way price will move in a real situation. I'm only showing you how price will reach towards where there is money or where there are orders. I hope you guys are getting it and you can watch the recording to follow through. So we have 10 minutes to get to the next session. So we'll break a little bit and then come back to the next session. So imagine you are a fisherman who is an institutional trader with a very big fishing net. That is your huge orders. If you drop your net anywhere in the middle of the lake, a random area or place, you might only catch a few fishes. That's not enough worth of your time because these people have big volumes or big money and they don't want to make small profits. So what do? You look for places where there's a lot of fishes will gather, maybe near a feeding spot or a shallow water where small fishes will hide. So there are obvious places where people will put their stop losses or people will want to trade. Those are the areas that the smart traders or the big people will target, like around support areas, around trend below and above trend lines. Okay, we'll look at all that. Okay, and double tops and double bottoms. All those areas are obvious places where people will want to be uh, doing activity. Retailers will want to be doing activities. So where to find liquidity? Again, once again, above obvious highs, that is called buy side liquidity. Um, Retail traders who short the market will put their stop losses above highs. I've already explained all this. And below obvious lows, sell side liquidity. That's called sell side liquidity. Also, equal highs and equal lows. That's what we see as double bottoms and double tops. Okay, all those areas are areas that the smart money traders or the big players in the market will want to target to take out the retail traders before they move the market to the intended direction they want to move it to. And also, when there are gaps, for example, one example I can show is like in the forex market, today is Sunday, the market is going to open. So over the weekend, there will be a gap that is normally created. So those gaps uh, will need to be filled during the trading week. Okay, so those areas can be areas. And then imbalances. Imbalances are areas of inefficiency like fair value gaps and all that. So all those fair value gaps in the market are areas that price will want to uh, go. That's why fair value gaps are very important. And we are going to study fair value gaps when we get to institutional reference point in our next or in our subsequent classes. In Proverbs chapter 27, verse 23, the Bible says that be diligent to know the state of your flocks and attend to your herds. So just like a shepherd carefully studies where his sheep are and keeps track of them, a wise trader would have to study where the market participants are positioned, where their stop losses, pending orders, and clusters of trades lies. That is the liquidity zone that we are studying today. So you have to make an attempt and you have to really study and know where exactly on this chart, in this dealing range or swing structure that I want to trade in, where would the stop losses be? Okay. And then once you know that, it's either you take profit when the market gets there, or you wait for that area to be taken out. And then when you see a reversal or a shift in structure, you join the trade to the opposite direction after the liquidity has been swept. Any questions for today? Any questions for today? Great. So let's go to the chart and do some real practice or do some real testing to find out more of how to identify liquidity in the market. Liquidity in the market. Are we good?
Yeah.
Perfect.
Okay.
Okay. So can you guys so